Let's turn to India now, where all eyes are on the Reserve Bank of India. We just had a disappointing GDP result, so the pressure was on it to cut interest rates to spur economic growth. As it turned out, the RBI resisted that pressure. They have kept the lending rates unchanged for the 11th consecutive monetary policy. But more importantly, they've also revised their forecasts. The RBI expected India's economy to grow by 7.2% in this financial year. That forecast has been cut to 6.6%. The inflation forecast has also been raised. Now, this policy came at a very important time, especially for the RBI's Governor Shaktikanta Das. His term ends next week. There is no word on a possible extension. Today, he was asked about his position at India's central bank. His answer is in our next report.
It's a tough job being a central banker. Tough and often thankless. You don't get credit when the economy booms, but you get the blame when it tanks. Just ask Shaktikanta Das, the governor of the Reserve Bank of India. He was under immense pressure this week. India's latest GDP numbers turned out to be disappointing. A mere 5.4% growth compared to RBI's 7% forecast. So everyone asked the obvious question, will the RBI reduce interest rates? Well, today we got the answer. A resounding no. The RBI kept the repo rate unchanged at 6.5%. In fact, it hasn't changed in 22 months. The repo rate is the interest on loans given by the RBI to commercial banks. The lower the repo rate, the cheaper our loans are. Which is why cutting this rate spurs spending and economic growth. But not this time. Because the RBI remains worried about a major factor, rising prices or inflation. India's inflation was 6.2% in October, which is a 14-month high. Cutting the repo rate would likely have increased that. So the RBI had a choice, play it slow and safe or risk a spike in inflation. The RBI governor chose the safe option.
Food inflation pressures are likely to linger in Q3 of the current financial year and start easing only from the Q4 of the current financial year, that is from January to March.
It's not all bad news though. The RBI did cut the CRR or the cash reserve ratio. It's been reduced from 4.5% to 4%. The CRR is the portion of total deposits that banks are required to maintain as cash. The rest can be given away as loans. The lower the CRR, the more loans the banks can give. It's not as effective as an interest cut, but it shows the RBI has one eye on growth. But will this be enough to restore India's economic boom? Perhaps not, because the RBI has also revised some forecasts. Earlier, it expected India to grow by 7.2% in this financial year. That has been cut to 6.6%. There's some hope that government spending will pick up in this quarter. But the RBI governor flagged some challenges, like global supply chain issues, conflicts and war in Europe and West Asia, and of course, sticky inflation. The RBI had projected inflation to be 4.5% in this fiscal year. That's been hiked to 4.8%. The main worry is food prices. Indian crops remain vulnerable to climate shocks and extreme weather events. As a result, food prices are volatile. But beyond the forecasts and interest rates, the monetary policy was important for another reason. The RBI Governor Shaktikanta Das's tenure expires next week. But there's no word on a possible extension. Das was asked about this today.
Have you heard anything from the government so far, whether you are continuing this term?
Okay, I'm not giving you any headline, and I think it's better we stick to monetary policy.
The RBI is expecting growth to pick up in the second half of this financial year. That would certainly settle the nerves. If not, it would set the stage for a crucial monetary policy meet in February next year. The question is, will Shaktikanta Das be around till then?